Hello everyone and welcome to This Week in the Markets. In today's video, we'll review Mario Draghi's speech last Thursday in front of the Global Investment Conference and its implication for the market and the ECB meeting tonight. We'll also go through the results of the FOMC meeting yesterday and some key economic data from US. But before that, we need to go through the disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So the big news last week that sent the market rallying was apparently a speech from Mario Draghi, which is the president of the European Central Bank, promising to do whatever it takes to preserve the euro. He even added the strong words, "Believe me, it will be enough." So the market is speculating that the ECB will restart the bond purchase program to help bring down Italian and Spanish bond yields. Traders responded to this by pushing the Spanish 10-year bond yields down sharply from above 7.5% last week to 6.7% as it stands today. The biggest hindrance to reenacting the bond purchase program was the resistance from Germany, but those concerns seem to have eased last week, as a couple of days after Draghi's comment, the German Chancellor Angela Merkel met up with the French President François Hollande and issued a joint statement saying that they would also do everything necessary to protect the euro. This is a stark contrast to a previous antagonist approach to ECB's intervention and suggests that perhaps something is on the agenda. In light of this, the ECB meeting tonight will gain even more importance than it already has, because the market will judge Mario Draghi not by its word, but through his actions tonight. The Federal Reserve met yesterday in its monthly rate decision meeting. There were some speculations that the Fed might provide more stimulus given the weak jobs report last month, but no immediate actions were announced. Nonetheless, the Fed statement remained dovish and states that the Fed is ready to provide additional accommodation as needed to promote a stronger economic recovery. One area that the Bernanke is keeping a particular close eye on is the European debt crisis and whether the conditions there would deteriorate and spread to the global financial market. Given ECB's potential actions later tonight, it is perhaps no surprise that the Fed prefers to hold off any actions which may not be necessary anyway if the ECB takes appropriate steps to contain the crisis. So the ADP private employment numbers, which was released yesterday and was actually a fair bit better than expected in July. According to this data, 163,000 private jobs were added last month in US. Analysts were expecting only 120,000 jobs, so this is quite a bullish report. The chart over here shows the comparison of the ADP report and the non-farm payroll. The white line is the ADP report and the yellow line is the non-farm payroll. As we can see, the ADP report tends to be quite correlated to the non-farm payroll, which will be released this Friday. But as has been the case in the past couple of months, ADP can be better than expected, but the non-farm payroll could still disappoint. Currently, the expectations for the non-farm payroll is net 100,000 jobs. The ISM Manufacturing PMI showed a slight improvement in July as well, but was still below analyst expectations. On average, analysts were expecting that the figure would come in at around 50.2, but instead it was at 49.8. For this indicator, above 50 means that the manufacturing sector is expanding, while below 50 means that it is contracting. So it is a bit disappointing to see it below the 50 level. Nonetheless, the sector is only contracting moderately after several years of expansion, so it is not too big a concern yet. We're 4 weeks into the earnings season and most companies have reported the earnings in the S&P 500. The average earnings surprise is much in line with the previous week at 4.04%. The average revenue surprise has improved a bit from last week and is marginally in the green now. Overall, the earnings announcement have been satisfactory but not exceptional, but given how bearish the market is, this is probably still quite a reassuring factor. So that's all from us this week. For the coming week, the ECB meeting tonight and the non-farm payroll tomorrow will probably be the two things to watch out for, as they will likely set the trading mood for the following week. RBA will meet next Tuesday to set the target rate for Australia for the following month. Currently, the expectations are that they will leave the rates unchanged as positive data have been flowing through from Australia. Next Thursday, before our next video, we should also see the results of the Bank of Japan rate decision meeting. The last meeting was pretty disappointing and it resulted in the yen strengthening to previous high in June. Yen traders will keep a close eye on this meeting to see if the central bank will follow its word to achieve a 1% target inflation. Otherwise, we might see the yen returning to where they were at the beginning of the year. We'll look at this in more details next week. Until then, on behalf of the Trading Pursuits team, we wish you all a profitable trading.